Friday, January 30th, 2026. A day that should have ended quietly instead shook markets worldwide. Silver plummeted from $121 to $95. Gold fell $650 an hour. But here's the shocking part. You cannot buy physical silver anywhere. Mints are suspending sales, dealers are defaulting, and stores are rationing inventory. The price is collapsing, yet availability is vanishing. Something is deeply broken. What you're seeing on your screen is not reality. It's a carefully orchestrated illusion. If you panic now, you'll lose. Watch closely, because what I'm about to reveal will expose the hidden mechanics of the silver market and why the paper price lies. The chaos in silver markets this week is more than volatility. It has a systemic disconnect between paper and physical markets. Normally, a crash triggers sellers to flood the market, increasing availability and lowering premiums. Not this time. Perth Mint in Australia, US Mint, and the Royal Mint in the UK have suspended sales. India's dealers are failing to deliver products even after payment. Costco is rationing purchases. The market appears broken because, while paper prices plunged, real silver vanished. This isn't a temporary glitch. It's a global supply crisis masked by manipulated numbers. Here's what most people fail to understand. The silver market is split into two worlds. The paper market trades contracts, derivatives, and promises of delivery, often without real silver backing them. Billions change hands every day, yet most of it is virtual. Meanwhile, the physical market is where coins, bars, and bullion exist in reality. The connection between these two is supposed to align, but right now it's fractured. Paper prices show $95. Physical supply? Non-existent. And the numbers confirm it. Perth Mint paused wholesale orders when silver was 117, not 95. US Mint couldn't keep up with pricing adjustments and suspended sales. India's physical supply chain is failing. Royal Mint has run out. Costco, known for bulk sales, is rationing silver. Meanwhile, Shanghai's vaults saw nearly 27 tons of silver removed in a single day. Physical silver is vanishing globally while the paper price crashes. This is not coincidence. This is deliberate, systemic manipulation. And if you don't understand the mechanics, you risk being trapped, selling your silver at the bottom, believing the paper price reflects reality, while those with knowledge accumulate the scarce physical metal. Now, let me give you a glimpse behind the curtain. What is really happening while everyone panics at the screens? While silver's paper price plunges, a quiet but intense battle is unfolding across the globe. American banks and hedge funds are aggressively selling paper contracts, derivatives, and promises of delivery. On screen, prices collapse. But these institutions are not touching a single ounce of physical silver. They are manipulating numbers, creating the illusion of abundance while scarcity grows. On the other side of the world, Eastern investors are quietly accumulating. China, Japan, India, and even Middle Eastern buyers are taking physical delivery, removing silver from circulation. Vaults are draining at unprecedented rates. Lease rates, the cost to borrow real metal, have spiked to as high as 39%, signaling panic in the physical market. The lower the paper price falls, the more urgent the scramble for real silver becomes. The market paradox is astonishing. A crash is increasing demand rather than suppressing it. This isn't a temporary glitch or a local problem. It's global and coordinated, whether intentional or structural. Every major mint and dealer across continents faces shortages. Perth Mint paused orders. The US Mint suspended sales and repriced silver. India's dealers are defaulting, and the Royal Mint in the UK is out of stock. Even retail stores like Costco are rationing purchases, limiting how much any one person can buy. And it gets more alarming. Shanghai's vaults alone removed nearly 27 tons of silver in a single day. At this pace, their holdings could be depleted in weeks. Physical silver is disappearing faster than anyone realizes, while the paper price is being driven down artificially. The lower the price on screen, the faster the real metal vanishes. What does this mean for you? The paper price is noise, a distraction. The world is scrambling to secure real silver while retail investors panic over digital numbers. The true story isn't on the charts. It's in the vaults, the mints, and the hands of those quietly hoarding metal. By the end of this section, you'll see that this crash isn't what it appears. It's a mechanism, a signal of deeper structural forces at work. And if you understand it now, you can position yourself to take advantage of a situation most people completely misunderstand. Let's take a step back and understand the full picture. What you guys are witnessing with silver isn't just a crash. It asks the culmination of a structural imbalance that's been building for years. The silver market is fundamentally split into two distinct worlds, paper and physical. The paper market consists of futures, ETFs, derivatives, and contracts. These are promises of silver, bets that something will be delivered at a future date. Most of these contracts never result in physical delivery. In other words, billions of dollars are traded every day without touching a single ounce of real silver. It's a giant virtual casino where numbers are shifted on screens to create the illusion of a functioning market. The physical market, on the other hand, is tangible. Coins, bars, bullion, the silver you can hold, store, or trade. This is the real asset. For decades, the price of silver has been set almost entirely by paper markets, while the physical market existed quietly in the background. This system has worked as long as paper and physical demand remained loosely aligned, but recent developments show that alignment is breaking down, and fast. Let's start with supply and demand fundamentals. Global silver production averages about 835 million ounces per year, yet global consumption exceeds 1 billion ounces annually. Industrial demand for silver is enormous, driven by solar panels, electronics, electric vehicles, medical devices, and countless other applications. On top of that, investment demand for coins, bars, and ETFs remains strong, and traditional uses like jewelry and silverware continue. Every year, demand exceeds supply by hundreds of millions of ounces. Over 5 consecutive years, this has created a cumulative deficit of over 800 million ounces, a huge amount that has to come from somewhere. Where does the extra silver come from? From above-ground stockpiles, vaults, government reserves, and recycled metal accumulated over decades. Think of it as a bathtub. Silver supply flows in from mines while demand drains it out. For 5 years, more water has drained than flowed in. The bathtub is nearly empty. The buffers that once protected the system are gone, and every new surge in demand starts to expose the fragility of this setup. Now, let's examine the current crisis. The Perth Mint, one of the most respected mints in the world, paused wholesale orders even before the recent price crash, citing unprecedented global demand and backlog for its silver coins. The U.S. Mint temporarily suspended sales and repriced its silver eagles from $91 to $160 in a single day, an 86% overnight increase. India's dealers have begun defaulting on deliveries. Customers pay for silver but receive nothing. The Royal Mint in the UK has run out of its most basic silver bars. Even retail stores like Costco are rationing sales. These are signals of serious physical shortages, not temporary glitches. Meanwhile, on the other side of the world, the Shanghai Futures Exchange vaults are being drained at unprecedented speed. On January 30th alone, nearly 27 tons of silver were removed from a single vault system. To put that into perspective, that's roughly 870,000 ounces in a single day, enough to satisfy enormous investor demand. At this rate, these vaults could be depleted in just a few weeks. Lease rates, which indicate the cost to borrow physical silver, have skyrocketed. Some reports show rates as high as 39%, a clear signal of panic among those holding physical metal. So why isn't the paper price reflecting this scarcity? The answer lies in manipulation and timing. Most of the aggressive selling in silver has occurred during U.S. market hours. When New York opens, prices collapse, red candles dominate, and panic spreads. But during Asian trading hours, Shanghai, Hong Kong, Tokyo, silver often stabilizes or even rises as real metal is accumulated. This isn't random, it's coordinated. Western institutions sell paper contracts, pushing prices down. Eastern buyers take physical delivery, draining metal from the system. The result is a global disconnect between paper and physical silver. Timing also plays a critical role. Big moves often happen on Fridays, end-of-month trading days, when options expire, futures settle, and traders square their positions. January, for example, had been a record month for silver, with gains exceeding 60%. The final day of trading saw the crash, a deliberate shakeout designed to frighten weaker hands, push prices down temporarily, and create opportunities for accumulation. Panic and fear are the tools of those who understand the hidden mechanics of the market. This is where history provides perspective. During the 1979 to 1980 silver squeeze, a similar disconnect occurred. Paper and physical markets diverged dramatically. Dealers ran out of inventory. Premiums on coins and bars soared. Investors couldn't buy silver even as prices were skyrocketing. Ultimately, paper prices had no choice but to align with reality. Prices went from $6 to $50 in a matter of months, an 800% increase. While the modern market has circuit breakers, limits, and a different regulatory environment, the fundamental dynamic remains. When physical supply cannot meet demand, the price must adjust, regardless of paper manipulation. Another critical element is the role of China. China treats silver as a strategic national asset, restricting exports and accumulating physical metal. While the US and European institutions sell paper contracts to manipulate prices, Chinese buyers and other Eastern investors are quietly hoarding real silver, removing it from circulation. This East-West dynamic creates a structural imbalance that can't be ignored. The West floods the market with digital promises. The East secures the actual metal. Over time, this imbalance will force prices upward as scarcity meets demand. Finally, the paper market's volatility masks reality. The crash, though dramatic on charts, has accelerated physical accumulation. The lower the paper price, the faster physical silver disappears. Lease rates spike, vaults empty, premiums explode. Investors who panic based on paper prices sell at a loss, while informed buyers acquire scarce physical metal at discounted nominal values. This is not speculation. This is the natural consequence of a system under stress. In short, what appears as a simple market crash is a multi-layered global event. A structural deficit in silver, aggressive manipulation of paper contracts, surging physical demand, hoarding by strategic buyers, and a coordinated shakeout of weak hands. The disconnect between paper and physical is at its most extreme point in decades. Understanding this story is not optional. It's essential for anyone navigating the silver market today. Now, here's the truth that most people completely miss. The crash in silver isn't random. It is engineered. The paper market is collapsing, showing a 22% drop in a matter of days. But the physical market is screaming the opposite story. Mints are shutting down, dealers are failing to deliver, vaults are being emptied, and premiums are skyrocketing. The paper price tells one story, the physical market tells another. One of these is reality, and it's not the numbers on your screen. Let's start with physical scarcity. Perth Mint, one of the most trusted global producers, paused wholesale orders before the crash, citing huge backlogs and growing worldwide demand. The U.S. Mint temporarily suspended sales of Silver Eagles, forcing a repricing from $91 to $169 almost overnight. The Royal Mint in the UK is completely out of basic silver bars. Dealers in India are defaulting on deliveries, accepting payment but failing to ship silver. Even Costco, known for bulk sales, is limiting how much silver a customer can buy. Every single major source of physical silver is under unprecedented stress. Meanwhile, Eastern investors are quietly hoarding metal. China treats silver as a strategic national resource, restricting exports and removing large quantities from public vaults. Japan, India, and the Middle East are accumulating physical bullion as well. In Shanghai alone, nearly 27 tons of silver were removed in a single day. Lease rates, the cost to borrow real silver, have surged as high as 39%, signaling panic and extreme scarcity. Every indication shows that physical silver is vanishing, while the paper price remains artificially low. So why the disconnect? Western institutions flood the paper market with sell orders, creating the illusion of collapse. They trade digital contracts, derivatives, and promises of delivery, silver that doesn't exist yet. Meanwhile, Asia and the Middle East are taking delivery of real metal. Paper falls, physical is hoarded. This is not a temporary glitch, it's a systemic, coordinated imbalance. Those controlling paper contracts manipulate perception, while those holding real silver accumulate value. Here's the key. The lower the paper price drops, the more urgent the scramble for physical metal becomes. Panic in the paper market accelerates demand in the real world, draining supply faster than ever. Investors who panic and sell based on paper prices are handing away physical metal at discounts to those who understand scarcity. Lease rates, mint suspensions, defaulting dealers, all confirm one undeniable fact. Real silver is scarce, and its value is rising independently of digital numbers. Finally, historical perspective reinforces this. During the 1979-1980 silver squeeze, similar dynamics played out. Paper prices diverged from physical reality. Dealers ran out of inventory. Premiums skyrocketed. Eventually, the paper market had no choice but to catch up with physical demand, sending silver to record highs. The current setup is different in players and rules, but the principle is the same. Scarcity drives value, and paper manipulation can delay but never prevent the inevitable alignment. The reveal is simple but critical. The paper crash is a smokescreen, a short-term illusion. Physical silver is vanishing. Those who understand this are accumulating. Those who react to digital prices are losing. The hidden economy is working exactly as it's designed. Fear drives cheap acquisitions. Scarcity drives real value. And those positioned in physical silver will be on the winning side when reality eventually catches up. Ask yourself, which side are you on? Are you panicking because screens say $95? Or are you seeing opportunity in a global scarcity of physical silver? Comment below with your take. Paper or physical? Who will win? Understanding this split is critical. Paper markets manipulate perception. Physical markets dictate reality. If you want to participate wisely, recognize the signs. Vault drains, mint suspensions, lease rate spikes. These are not anomalies. They are signals of a major shift. This moment is a test. React emotionally and you lose. Observe, understand, and act strategically, and you gain. History rewards those who recognize the underlying mechanics, not the headlines. Remember, the price is crashing, but the product is disappearing. That paradox is your clue. Every drop on screen increases real-world scarcity. Every panic sale strengthens those accumulating physical silver. If you forget everything else, remember this. Paper silver is an illusion. Physical silver is reality. Mints, vaults, and lease rates reveal what numbers on your screen cannot. Watch the market, but act on truth. Hold, accumulate where possible, and never confuse the paper price with actual value. The story is unfolding, and the next chapter will reward those who understand the mechanics. Stay alert. The crash is not the end. It's the signal. The hidden economy moves quietly behind the headlines, but it dictates wealth transfer. Those who know will act. Those who panic will lose. And now, you know how the trick works. The price may crash, but scarcity is real. Paper fools you. Physical delivers.